Hey, JJ here with the Art of Value. So today I want to talk about a memo by Howard Marks, veteran investor Howard Marks, a memo called Bull Market Rhymes, which is really important, a really good one, I think. I'm going to summarize and give my thoughts on it. If you want to hear the full podcast and you're seeing this on Twitter, I'll put the first few seconds up there, but click the links to go to the full podcast. All right, let's get straight into it. So bull market rhymes. So he talks about last few years really in the stock market and what's happened. He wrote a book called about market cycles a few years ago. His last book, it was really good, so he talks about that too. But he starts off by saying, one of my favorite adages is widely attributed to Mark Twain. History doesn't repeat itself, but it does rhyme. It's well documented that Twain used the first four words in 1874, but there's no clear evidence that he ever said the rest. Many others have said something similar over the years, and in 1965, psychoanalyst Theodore Rake said essentially the same thing in an essay titled The Unreachables. He said, there are recurring cycles, ups and downs, but the course of events is essentially the same, with small variations. It has been said that history repeats itself. So this is perhaps not quite correct. It merely rhymes. The events of investment history don't repeat, but familiar themes do occur, especially behavioral themes. It's these that I study. That's Howard Marks saying that. In the last 2 years, we've seen dramatic examples of the ups and downs Rake wrote about, and I've been struck by the reappearance of some classic themes in investor behavior. They will be the topic of this memo. I want to mention up front that this memo has nothing to do with assessing the market's likely direction from here. So he's not predicting what's going to happen from here, but just looking at the last couple of years. A bull market shouldn't be defined as a percentage price movement. For me, it's best described by what it feels like, the psychology behind it, and the behavior that the psychology leads to. Does it really matter whether the S&P 500 is down 19.9 or 20.1%? I prefer the old school definition of a bear market, nerve-wracking. And we could say that it's kind of been nerve-wracking lately. I mean, the Nasdaq's down way more than 20%, as he said. That was from a news headline about the market being 19, 20% down, but it feels like a bear market right now. There's no doubt about that. I think you have to agree. So he says, excesses and corrections. My second book is Mastering the Market Cycle, Getting the Odds on Your Side. I would highly recommend that book. I've read it. It's really good. And I read it before like the 2020 COVID sort of bust, and then the parabolic move after that. So it was a really good time for me to read it. It's well known that I'm a student of cycles and a believer in cycles. I've lived through and been schooled by several significant cycles during my years as an investor. I believe understanding where we stand in the market cycle can give us a hint regarding what's coming next. If the stock market was a machine, it might be reasonable to expect it to perform consistently over time. Instead, I think the substantial influence of psychology on investors' decision making largely explains the market's gyrations. So behavioral investing, that's generally called, and he talks about that in the book, and market cycles, talking about taking the temperature of the market. Anyway, let's go on. When investors turn highly bullish, they tend to conclude A, everything's going to go up forever, and B, regardless of what they pay for an asset, someone else will come along to buy it from them for more, the greater fool theory, because of the high level of optimism. So he's got some bullet points here. Stock markets rise faster than company profits, soaring well above fair market value, excess to the upside. Eventually, conditions in the investment environment disappoint, and or the folly of the elevated prices becomes clear, and they fall back toward their fair value. That's correction, and then through it. So past the correction stage. The price declines generate further pessimism, and this process eventually causes prices to far understate the value of stocks. That's excess to the downside. Resultant buying on the part of bargain hunters causes the depressed prices to recover toward their fair value correction. The excess to the upside makes for a period of above average returns, and the swing towards excess on the downside makes for a period of below average returns. There can be many other factors at work, of course, but in my view, excess and corrections cover most of the ground. We saw a number of excesses to the upside in 2021, and 2021, and now we're seeing corrections thereof. So he talks about, this is just a summary. He goes further talking about how market spends most of its time to the upside or downside. So the S&P 500 averages, for instance, you never really get the average. It's usually more or less than the average. So, it doesn't, as far as the swings go, it's hardly ever kind of in the middle. It's always up or above, like a wave. So, bull market psychology. In a bull market, this is a heading in bull market psychology. In a bull market, favorable developments lead to price rises and lift investor psychology. Positive psychology induces aggressive behavior. Aggressive behavior leads to higher prices. Rising prices encourage rosier psychology and further risk taking. This upside spiral is the essence of a bull market. When it's underway, it feels unstoppable. So, yes, can we think of any time recently in the last couple of years where this has happened? We saw a classic collapse of asset prices in the early days of the pandemic. For example, the S&P 500 reached a then all-time high of 3,386 in February 19, 2020, before falling by 1/3 in just 34 days. Yes, I'm sure most of us remember that well. If you're not super new to investing, to a low of 2,237 on March 23. After that, a number of forces combined to produce massive price gains. Here we go. I think we will remember that. The Federal Reserve cut the Fed funds rate to roughly zero, and the Fed was joined by the Treasury in announcing massive stimulus measures. These actions convinced investors that the institutions would do whatever it took to stabilize the economy. The interest rate cuts significantly reduced the prospective returns required to make investments look attractive in relative terms. This combination of factors forced investors to bear risk they had been running from just a short time earlier. Asset prices rose. By late August, the S&P 500 had retraced its decline and surpassed its February high again. The FAMG, Facebook, Amazon, Apple, Microsoft, and Google software stocks and other tech stocks rose dramatically, pushing the market higher. Eventually, investors concluded, as they often do when things are going well, that they could expect more of the same. And I remember this so well. This is when people let's just call it, started piling in. So the most important thing about bull market psychology is that, as cited in the final bullet point above, most people take rising stock prices as a positive sign of things to come. Many are converted to optimism. Relatively few suspect that the gains to date might be excessive and borrowed from the future returns, and that they may herald a reversal, not continuation. That reminds me of another of my favorite adages, one of the first ones I've learned roughly 50 years ago, the 3 stages of the bull market. So I think this is really simple and really succinct here, and it's worth really remembering. For the next time around the block, whether that be 10, 20 years or earlier, or in certain sectors and certain stocks. The first, when a few forward-looking people begin to believe things will get better. The second, when most investors realize improvement is actually underway. And third, when everyone concludes that things will get better forever. And I heard a lot of people say that in late 2020, and their whole stocks only go up. So the bull market of 2020 was unprecedented in my experience, in that there was essentially no first stage of the very little of the second. Many investors went straight from hopeless in late March to highly optimistic later in that year. This is a great reminder that while some themes do recur, it's a big mistake to expect history to repeat exactly. Raging bull markets are examples of mass hysteria and at the extreme thinking, and this behavior becomes unmoored from reality, In order for this to occur, however, there has been some factor that activates investors' imagination and discourages prudence. Thus, special attention should be paid to an element that almost always characterizes bull markets: a new development, invention, or justification for rising stock prices. So this, I've done previous episodes of a book called Boom and Bust. It was about financial bubbles, and they say that too. It's either, they kind of boiled it down to two things that could kind of cause bubbles, and that was, a new technology. People getting super excited about a new technology, new innovation. And we can think about the innovation stocks. It was actually called innovation this time. And also another one is government policy. Sometimes, like real estate boom, real estate bubbles can be generated that way. So bull markets are Mark says, bull markets are by definition characterized by exuberance, confidence, credulousness, and willingness to pay higher prices for assets, all at levels that are shown in retrospect to have been excessive. History has generally shown the importance of keeping these things in moderation. For that reason, the intellectual or emotional rationale for a bull market is often based on something new that history can't be used to discount. So it's new. It's a new economy, like in the dot-com bubble. All the previous previous metrics don't matter. We're in a new era. Sort of happens quite often in these super bull markets in certain sectors. Or in the dot-com bubble, it was pretty widespread. Those last 6 words are very important. History amply demonstrates that when A, markets exhibit bullish behavior, B, valuations become excessive, and C, the latest thing is accepted without hesitation, the consequences are often very painful. Everyone knows, or should know, the parabolic stock market advances occur and recur, abetted by what I learned in high school English class to call the willing suspension of disbelief. I don't think investors are actually forgetful. Rather, knowledge of history and the appropriateness of prudence sit on one side of the balance, and the dream of getting richer sits on the other. The latter always wins. Memory, prudence, realism, and risk aversion would only get in the way of that dream. For this reason, reasonable concerns are regularly dismissed when bull markets get going, which is so true, and we have all experienced that recently with certain stocks and sectors. Another justification for bull markets is often found in the belief that certain businesses are guaranteed to enjoy a terrific future. This applies to the nifty 50 growth companies of the late 1960s, disk drive manufacturers in the 1980s, and telecom, internet, and e-commerce companies in the late 90s. Each of these developments was believed to be capable of changing the world, such that the past realities of business need not constrain investors' imaginations and willingness to pay up. In many bull markets, one or more groups are anointed as what I call super stocks. The rapid rise makes investors increasingly optimistic in the circular process that often characterizes these markets. This rising optimism takes the stocks to still higher prices, and some of the positivity and appreciation reflects favorably on other groups of securities and all securities through relative value comparisons and or because the general improvement in investors' mood. So he's saying topping the list of companies that fed investors' excitement in 2021 were not the FANGs, the FAMGs, he says, FAAMG, so he's including Microsoft there and not Netflix, whose level of market dominance and ability to scale had never been seen before. The dramatic performance of the FAMGs in 2020 attracted attention of investors and supported a widespread swing towards bullishness. So he's talking about this is the kind of bubble. Well, the bigger stocks, it was smaller stocks that really took off, wasn't it? But it caught fire and spread. These stocks had nearly doubled from their March lows and were up 61% from the beginning of the year. Notably, these 5 stocks and heavily weighted in the S&P 500, so their performance resulted in a good overall gain in the index, but this distracted attention from the far less impressive performance of the other 495 stocks in the S&P 500. The performance of the super stocks inflamed investors' ardor, enabling them to disregard worries regarding the persistence of the pandemic and other issues. The raging success of the FAMs created a luster that reflected positively on tech stocks in general. Demand soared for stocks in the sector, and as is usual, in the investment world, strong demand encouraged and enabled supply. And so then he talks about the IPO process. One notable barometer in this case was the attitude towards IPOs and the unprofitable companies, which soared. Prior to the tech bubble of the 1990s, IPOs from companies that didn't make money were relatively rare. They became the norm during the bubble, but their numbers sank altogether thereafter. In the 2021 period bull market, IPOs from unprofitable companies experienced a big resurgence as investors eagerly made allowances for tech companies' desire to scale, and biotech companies need to spend on drug trials. All right, I'm going to leave it there because we're up to when the bubble took off, and I'm going to break this into two. So I find this is a fascinating memo, and I know a lot of people won't read it, so I'm kind of just summarizing it and saying what I think. But he spells it out, and the next is a SPAC. So I'll leave it there. So if you found this valuable, and subscribe on YouTube and for video, YouTube and Spotify video, and catch me on Twitter at The Art of Value. As I said, I'll put the first few seconds of this on Twitter, and I'm going to do part 2, and I'll upload that to break it into 2. So ring the bell on YouTube and on Spotify to be notified of the second part of this. Okay, see you next time.